The tax code is ever-changing, which means your strategies should be ever-changing. Don't get stuck with your heels dug in the ground, and make sure that your plan is as up-to-date as it needs to be. Welcome back to Consider This Program. I'm your host, Jamie Burton.
And I'm Aaron Rheaume.
So glad to have you guys here today with us. We are talking about taxes because the tax filing deadline is coming up here shortly. And we want to make sure that today we're talking about all of the tax code changes that have occurred and how we have to make sure that our strategies around tax planning are keeping up to date with those changes. And also we see some changes coming up on the horizon. What are we doing to make sure that if those changes do happen, that we're doing the most efficient thing today for those changes? One of the big things that we know right now with the tax code change is that the tax brackets, the percentages have gone down since 2017. So previously it was 10%, 15%, 25%, and so on. Right now the tax codes have taken a cut back. So now it's 10%, 12%, 22% and up. What are we doing today to take advantage of those tax brackets being cut?
There's a lot of things that you can do. And so what the most prevalent thing is, you're probably referring to Roth conversions.
Mm-hmm.
And so what a Roth conversion does is it allows you to move money from an IRA that's tax deferred, pay tax, and move it to a Roth IRA, which grows tax free. There are so many things that we need to consider when we do Roth conversions. As I've said on many episodes, when we do this, most people's situation is unique. It's not a cookie cutter approach. Incomes vary, tax rates vary, but the Roth conversion is literally one thing that you can do today to prevent future taxes. I can go on and talk more about why I think that's the right thing to do, but I'll let you guide the conversation.
Sure. So when we're looking at people's individual situations and we're looking at the different investments that they have and how they're laid out from a tax standpoint, it gives us a better idea to know if it makes sense to do a Roth conversion today. What we know is that when people get to retirement, if they aren't using their tax deferred dollars, that once they hit the age of 72, the IRS is going to start requiring them to take money out of their tax deferred dollars in the form of a required minimum distribution. So if we look at their situation and see that they have these tax deferred dollars today and they are in a preferential tax bracket, say 12% or 22%, and we can start taking dollars out today that we can control the taxation on. We know exactly what they're going to be paying in taxes, especially knowing that the tax rates are eventually going to go up. We can help them today on their tax rates, and then we can help them in the future when the IRS comes knocking and says, okay, time for you to start taking out a percentage of your assets, whether you need it or not. So that's a huge benefit of being able to do Roth conversions. But we know that with the tax code changes, with the environment that we're in today, that it's great to be able to take advantage of this tax environment.
Yeah, so let me kind of propose a scenario, right? And so we see people that have all different types of assets and they're saved in all different types of accounts. You have tax deferred, you have what you're talking about with the Roth, which is tax free. You've got brokerage account money, which we call taxable, and that could just be a stock account. When you're walking through, does it make sense to do a Roth conversion? We have to focus on not taxes today, that's taxes today and tomorrow. And so let's say, you're 60 and you're really contemplating retirement, and you have built up a good nest egg of tax-deferred dollars, and you're looking at potentially starting Social Security at 62, like many of the people that we see on episodes that you've talked about in the past. People take Social Security at 62. That's just because they have a fear of running out. Well, again, going back to what Jamie has talked about is we know taxes today are what we would call on sale. So that 15% bracket is now 12. And so when we're helping people kind of make their guide their thoughts or give them guidance on this, we have to know what your standard of living is. And so for us, that means what does it take for you to maintain your lifestyle? And that's different for everybody. And so let's take that 60-year-old couple, married filing jointly, and let's say their standard of living is $5,000 a month. That's what they need to be able to eat, travel, pay their bills. And so 5,000 times 12 is $60,000 a year of gross income. Take off a standard deduction of roughly $25,000. Their taxable income, which is where the marginal brackets fall, would be roughly $35,000. So that would keep that couple in today's tax code right at the top of, or right around the 12% bracket. So the top of that today is roughly $83,000 of taxable income. So we know in this situation that having an income that's taxable of $35,000 to the top of that bracket's $83,000. So we've got a large window to where we could recognize tax and still keep that couple in a 12% bracket. And so why we would do that is, again, we know the tax code at the end of 2025 sunsets. That 12% bracket goes up to 15%. The 22% bracket goes to 25%. And so we want to take advantage of that as well as we can. Again, you mentioned this, the reason you would look at that is because that $1 million IRA is going to continue to grow until they reach required minimum distribution age. And you have to pay attention to how all of that stuff works together.
Absolutely.
So we could potentially reduce future required minimum distributions, potentially putting them in higher brackets in the future. And one of the key things to consider Roth conversions is most people save married filing jointly. And a lot of times, Jamie and I and some of the other advisor team have seen where a spouse passes away. And now your brackets are significantly compressed. So I mentioned the top of the 12% bracket is at $83,000 in 2022 of taxable income. That gets reduced in half. So it goes right down to about $40-some thousand, and things don't stop from an income standpoint. Social Security can come in, pensions can come in, and so you could be in a significantly higher tax bracket just because a spouse passes away.
Absolutely.
Sorry, it's long-winded, but I am passionate about Roth conversions and tax planning.
Absolutely. And when we see that a spouse passes away, that income, it's cut in half, but you don't see the expenses cut in half, right?
Right.
So you still have a spouse that is in a household that still has all of the expenses of keeping up a household and all of the expenses of a car payment and the mortgage. So all the expenses that were still there, that started being there, are majority of them still there. So although you have this tax bracket that's cut in half, you still have the same income needs. You're still going to have all the same mailbox checks coming in. You're still going to have the higher of the two of your Social Securities coming in. If you have any pensions, those are still going to be coming in. And if you have required minimum distributions, you had your spouse's tax-deferred accounts and your tax-deferred accounts. Well, your spouse's tax-deferred accounts now become yours also, but the required minimum distributions don't go away. You still have to take the required minimum distributions of that entire balance. So you still have all these checks coming in, whether you need them or not. And if you don't do any tax planning, like Roth conversions, that can really hurt you in your retirement, something that you didn't prepare for sure.
Yeah, and we see it all the time.
We do. And there was also a tax code change that can really affect your beneficiaries in the future that came out in the Secure Act in 2019. Can you explain that a little bit?
Yeah, that eliminated what we call the stretch IRA, and it ties right back into the purpose of considering Roth conversions. The painful part about a Roth conversion is you're really not doing it potentially for yourself. You're doing it for your loved ones. No one likes to pay tax, and so by paying that forward, it can be painful financially. However, with the stretch IRA being eliminated, what that was it allowed a beneficiary, a recipient of an IRA, to be able to take required minimum distributions out over their life expectancy. So that could have been another 30, 40, 50 years. Well, at the end of 2019, they said, no, that's gone. We're getting rid of that. Instead of that stretch, now we're going to make the beneficiary, non-spouse beneficiary, take the tax deferred and even Roth dollars out over a 10-year period of time. It does not have to come out at 10% over 10 years. It just, all of those dollars have to be out of the account by the end of the 10th year. And so that, again, can play a significant impact on someone's future tax liability, and you have to pay attention to those types of things.
Mm-hmm, absolutely. And I've seen people come in to where they have, say, $1 million IRA, and they're okay with taking out the required minimum distribution that is coming through. They're okay with that. They need that much money to live off of. It keeps them in a decent tax bracket. All is good. But then when you start having the conversation about, okay, what are you doing with the money when you pass away? Who are your beneficiaries? Who is that going to go to? That's when you start seeing the real problems unfold. Can your wife handle the required minimum distribution on $1 million IRA when she is now filing single?
Mm-hmm.
And that's now cut in half. Can your children, can they handle inheriting $1 million IRA when they now have 10 years to take all of that money out and all of that money is hitting their tax return? So it gets to the point where when you're thinking about yourself, yeah, you can be sitting in a really great position, but you have to take a step back and think about your beneficiaries and your loved ones, and you really have to decide, is it going to be okay for them? Is this going to hurt them negatively? Is my spouse going to be blowing through all the money when I pass away because she doesn't have a choice and the IRS is making her take all that money out and she's giving way more to the government than what we planned for? So those are conversations that you have to have. They're conversations that are not easy to have. They are not easy to work through in your head. You really have to sit down and hash out what your wishes are for your loved ones and for your beneficiaries. And you just have to determine what is best for your unique situation. If you want to do that on your own, that's your business. If you would like to talk to a fiduciary to help really hash those things out, that's our business. You can give us a call at 800-928-4001.